And welcome along to our next lesson on short selling and hedging. Some of the things we'll be covering in this lesson include an introduction to short selling and what it's all about, some of the applications and uses for doing it. We're going to review a short trade, and we're also going to discuss or give you an overview of contracts for difference, also known as CFDs. So short selling is where the investor initially sells shares in anticipation of buying them back at a lower price after an overall downturn or downtrend in the stock. This involves borrowing the shares from a lender and then returning them at the completion of the trade. However, as an alternative to that approach, the transaction is mostly performed using derivative products such as a put option or a CFD. So this technique is usually done in bear markets or overall downtrending stocks. So this would be the concept of an overall downtrending stock. And of course, it's these little counter rallies here towards the long-term downtrend line that give you that opportunity to potentially hedge or profit from the next leg of the expected downturn. Indicators like distribution, which are the Ds at the top of the chart, in relation to the counter rally, testing the trend line resistance line, can represent a good opportunity for short selling in anticipation of further downward movement. So the whole purpose of short selling is to either profit from an expected downturn, or if we talk about using short selling for hedging, it's to recoup back what our stock may be about to lose from an expected downturn. So here's a chart exhibiting these characteristics. The red line shows a very conservative long-term downturn. The green lines show the more short-term or aggressive declines in the stock. Depending on how aggressive or conservative you are, you might be actively hedging or short selling the downturns which are represented by the green arrows. Or if you take a more long-term view, you might only be interested in the downturn being shown to you with the red arrow. So each individual has their own way of approaching trading and or investing, and they are the different types of downturns you could profit from or hedge with stocks. So hedging and short selling, really short selling, as I've said, is all about profiting from a downturn in a potential stock. Hedging is where we try and protect an existing long position, which is a stock you own, by taking a second short position, usually using a derivative product. The initial long position, the stock we own, continues to be held, whilst the potential fall is being negated or recouped back by our second short position, and this is known as a hedge. The hedge trade utilizes a derivative product such as short selling CFDs or even buying a put option based on the underlying stock. Now, both those products, CFDs, particularly short selling CFDs and buying put options, allow you to profit from downturns in a stock. As the stock falls in value, the derivative position is actually gaining profits. For a neutral hedge, you would have an equal value on both sides. So if you owned 1,000 shares, you would short sell 1,000 CFDs. The hedge profit should then buffer the fall in the original stock's positions. So as the stock is falling in value, our derivative position, which is typically the CFD trade, is recouping back what the stock is actually losing. In terms of hedging signals, any signals of weakness in the medium to long-term trend should cause you to consider action. In general, any of the trend following indicators may be used to gauge potential weakness. So they could be things like trend line breaks, showing your break of medium to longer term trends. You could be using indicators like ATR trailing stop dots, moving averages such as a 200-day weighted moving average, parabolic SAR dots, large-scale bearish divergence on momentum indicators such as CCI, RSI, and MACD. and even market conducted dots on a weekly, monthly chart could be a reason to consider hedging for a potential downturn on the stock. So here is an example of a hedging signal. So in this case, we're looking for a break of both the overall rising trend line and the 200-day weighted moving average. Also on the chart is an indicator, momentum indicator known as CCI, which is showing a fair amount of divergence associated with the uptrend that was taking place. So here's the chart making a series of higher peaks, but we know the indicator is making basically lower peaks and or equal peaks. And that's a sign the uptrend could be losing momentum, slowing down, and is a prelude to a possible downturn from there, which sure enough, it did. So let's go through an actual hedging example. So our hedge signal in this case will be a break of the overall long-term rising trend line in conjunction with a break of the 200-day weighted moving average. Therefore, we're entering the hedge at $35.09 based on the break of the trend line and the weighted moving average, suggesting the start of an overall longer-term downturn in this stock. Sure enough, the stock does continue to decline. So what's a good exit signal for a hedge? How long should we maintain it? Once again, it depends on how aggressive you want to be with the exit, but if we're taking that same long-term view, our exit signal in this case is waiting for it to break up through the downtrend line and the 200-day weighted moving average. So in this case, it breaks through the downtrend line and our 200-day weighted moving average, giving us a signal to exit the hedge at $23.29. So a fairly substantial downturn took place using this method. So our chart showed signals of weakness, which indicated a hedge was necessary. So assuming we own 1,000 WOW shares and wish to protect them, we could short sell 1,000 Woolworth or WOW CFDs short at $35.09. This would constitute what we call a neutral hedge. So a neutral hedge is an equal long, equal short position. So you own 1,000 shares, you're short selling 1,000 CFDs. So that is a neutral hedge. Effectively, if your Woolworth shares continue to fall in value, the gross profit of our short position with the CFD would be equal to the loss of the physical share, thereby neutralizing the negative price action. So it's a way of recouping back what our stock is potentially going to lose. So a breakdown of that example, we short sold 1,000 Woolworth CFDs at $35.09. The share price in Woolworths did fall, and then we close out the hedge by buying back 1,000 Woolworths CFDs at $23.29. So when we buy the CFDs, we're not actually buying or owning any additional CFDs or shares. It's simply closing out the short position and basically profiting from that downturn. So the gross profit between where we initiated the hedge at $35.09 to where we closed out the hedge at $23.29 was $11.80. You multiply that by 1,000 CFDs, gives you an overall gross profit of $11,800, and that's not including brokerage in that particular example. So that's what your stock would have also lost if you didn't do the hedge. So you can imagine how you'd feel if your stock just declined by nearly $12,000 in this particular case. So by initiating a hedge, we actually recouped that back and feeling a lot better in terms of why we did that. So short selling with CFDs offers you leverage. Generally, the margin requirement for a CFD is between 10 to 25%. So it's a margin deposit based on the underlying value of the stock. Now, the key word there is it's a deposit, which you get back should you have a winning trade. So in our example, we made a profit. So the 10 to 25% deposit we had to put up would then be returned to your account along with your profits. However, there is a bit of a limited list of shares that are available for short selling with CFD, so not all stocks are available for short selling. It would also require you to have a trading account which gives you access to CFD products. So not all trading accounts offer you CFD, so you'd need to specifically find an account that allowed you to trade CFD products. And of course, we recommend doing the CFD workshop before trading with CFDs, just to have a better understanding of the risks involved and how they work. And of course, you read the CFD dealer's PDS, product disclosure statement, for more information about the CFD margin requirements and general trading conditions of the CFDs available through that particular dealer. Now, the other way we can hedge and or short sell, if you like, is with the use of put options. So this offers you variable leverage. Margins required will vary with different underlying stocks. Once again, there is a limited list of optionable stocks available to you. So not all stocks are going to have options, or specifically put options in this case, available to you. So you need to check that out and see whether that is a viable option. Options can be traded through your virtual trader equity options trading account. So if you've got an account through your virtual trader for shares, then generally options are also available through that one account. So that saves the second account with CFDs. Options, however, are more complex products, and you should acquire an understanding of their features. We recommend you attend the options workshop before trying to trade these products. And when you're getting started, start leaning on the trading advisors or the dealing desk you're working with to get some assistance in working with options. Some of the advantages of short selling. So you own a shareholding and you feel their value may fall. So selling your shares means you may incur capital gains tax. So a big argument against selling your shares and taking the profit is you may incur capital gains tax. And of course, if you hold a stock for more than 12 months, you typically qualify for a 50% discount in capital gains tax. So there are many reasons for avoiding having to sell the stock, and hedging certainly gives you the ability to avoid having to sell the stock and ride out any declines, but also means that you could keep receiving dividends along the way. Whereas if we sold the stock, well, suddenly we're no longer receiving the dividends. So instead of selling, we could short sell and or hedge the stock with a CFD or even a put option. The benefits include the ability to keep receiving your dividends on your stock, protects the overall profit in the stock value as of the time you initiate the hedge, helps you to avoid capital gains tax on the underlying share price since the profit remains unrealized. Some of the disadvantages to short selling. So let's say you did short sell or hedge a stock. If the price were to rally, you may be required to provide more margin to cover the price difference. In other words, if the stock is going up and you're short, you suddenly start to lose money on the derivative position. So therefore, additional margin may be required. However, if it is a covered strategy and you actually own the stock, then obviously at the same time, your underlying shares are appreciating by the same amount. And of course, any dividend on the stock must be paid to the provider of the CFD you're using. So it's just one of the features of CFDs. If you short sell a CFD and it goes ex-dividend, then you are profiting from the ex-div drop, which is typical of an ex-div date. But the dividend amount is then passed back to the CFD provider. However, once again, if you own the stock, you are still receiving your dividend as you always would. So using CFDs, there is also an interest component payable. So it's an additional cost on top of brokerage. So interest is not applicable to options. So it's more of a CFD trading vehicle interest cost. So we recommend doing some derivative trading if you're going to get into hedging. So to learn more about trading with derivatives like options and CFDs, then you want to contact us and look at the CFD and options courses available. Thanks for listening. I hope you enjoyed that lesson on short selling and hedging.